No, yeah, sure. Maybe stop and then we'll restart it. Yeah, there you go. All right. Okay, we're about 4 minutes into it. I'm sure more people will jump in. All right. Well, good morning again. This is JJ Risha with Pismo Ventures, and we are the host of the Global Startup Symposium. It has been a really a great week so far, and we started last week with early access. A lot of companies have been able to reach out and connect with investors. As a matter of fact, I don't know if I mentioned this to you, Dave, but one company said they connected with 40 investors
Now
on
that's a
this
record.
platform.
That's nice.
That's like mind-boggling.
Hmm.
So we have about 200 investors registered, but this is amazing. So I hope everyone can do the same thing. It's an open platform allowing anyone to connect with anyone and the ability to really reach out to investors. So please take advantage of the platform and the tools that are available and reach out to the investors that are on the platform. It's um, it's a great way to connect and engage, and hopefully you'll be able to continue the conversation with them. So today is we have two webinars. One is by Dave Burkus, and Dave is a longtime investor, angel investor, many ventures. I'm sure he will tell you all about it. Many investments, and he is one of the early investors at Tecos Angels, which was formed in 1997, and when I joined in 2008, he was my mentor as well. So I've learned everything from him. Uh, and I have contributed to one of his books, which he
Yeah.
will tell you about. He has a series of books called Burkonomics, and I have, I think, 7 or 8 chapters or something like that in in one of the books. Um, you can find them on Amazon, so make sure you look them up. They're great books about really it's for founders and what founders should be doing. Um, I'm sure he will tell you all about that. We have another webinar today by another Dave, David Friedman, also a Tecos Angels or TCA Venture Group. Both Dave Burkus and David Friedman are chairman emeritus for TCA Venture Group. Um, so the one from David Friedman today is about what really investors want. So, um, all right, and later in the afternoon at 1 p.m. Pacific time, we will start with the presentations. Today is all tech companies that didn't fit in previous days which were life science, AI, and deep tech. So today is every other companies that did not fit in these categories. So we look forward to keeping you going and engaged on the platform and seeing the webinars and the presentations later on. Dave, it's all yours.
So, JJ, what you're telling me is I don't fit.
Oh no, not you. The presentations later today.
I got it.
Your presentation and webinar fits everybody should know that for sure.
Well, hello, everybody. First of all, I have been a member of Tech Coast Angels from the very first class, and I was the third chairman of TCA, and I've watched it grow for the last 20, I don't know how many years. But I've been an angel investor since 1993, before the term angel was even invented for this purpose. It was only used in Broadway for Broadway productions. So I called myself a resource capitalist, and I wrote a book in 1994 called Better Than Money. And that was my first book. It's followed by 13 other books. What I'd like you to do, anyone who is watching, and I hope that everybody is at some point today, go to Berkus.com, Berkus.com. Explore around. There are some great things there. Uh, First of all, sign up for the Tuesday emails, because the kinds of things you're going to hear from me in the next hour are the kinds of things I talk about in just 300 to 600 words per week. You can read that in 3 minutes. And these are things absolutely that you need to know, as the one I'm about to show you in just a moment. You can also find a bot where you can ask me any question and my bot will answer based upon the 14 books. And you can also find two bots talking to each other about me and about the website. And you can also find a video that is another bot talking about the Berkus method of valuation, which is something that's been around since 1996 and used by over 1 million entrepreneurs over the years. And so now I've introduced myself. I've made 209 investments. I've managed the ACE Fund for Tech Coast Angels. I have run two companies in my past and one right now. One of them was a $100 million company that I sold, and that was really where I began making my investments. So enough of me. Let's get to where we belong here. You should see on your screen right now a title screen entitled Equity and Options, Opportunity and Danger. Now, I'm going to have to explain that, right? So pay a little attention because this one could be a little bit more complex than some of the things you've heard because equity and options are complex. So here's the warning. The execution of partnership or corporate equity allocations and a good incentive program using equity is usually mismanaged. And it damages the corporate capitalization structure and it even affects the outcome of subsequent investments in the company. Have I got your attention? And here's the usual trap. First, there's a brand new enterprise often formed from the efforts of a couple of partners, each with the expertise valued by the others. Sound familiar? And equity is divided among the founders and the business has begun. And all this insight does is to address the ignition. But what happens after the ignition? We should note in passing that things change over time, and formerly strong founder contributors can become a drag on a business or lose interest if the enterprise is not quickly successful. And this has happened so many times out of my 209 investments. There has to be something about that. So the something is protecting against those role changes. How do you do it? So to protect against this, there must be some document in place at the beginning. I mean, the beginning, maybe even before incorporation, that clearly states the expectations of each of the founders as they contribute their time and resources to this enterprise that you're beginning. And this document should contain a clear buy-sell clause, forcing the sale of shares to first be offered to the corporation's treasury, but the corporation usually doesn't have the money, then to the other founders in proportion to their holdings, and then, if there's no interest from those people, to outside investors who are accredited investors. This buy-sell agreement should contain a mandatory sales clause in the event of separation of a founder, so that a majority owner who's passive in the enterprise can't easily vote against measures that the active founders endorse. So did you get it? Let's have a buy-sell agreement. Let's make sure that the person who leaves, no matter for what cause, for cause, no cause, whatever it be, has to sell the shares back, or there is some reason why the agreement calls for them to be able to keep it. Really important. So here are some rules about stock options and phantom stock. The real insight here is that stock options or phantom stock are tools used by early stage businesses to attract great talent when there's not enough cash to pay the market rates. I know that most of us here in this virtual room don't have the money to pay the people we need to bring on board. And so we do it with equity or the equivalent of equity. So first, you need to create a stock option plan. And it usually means using your attorney. And it has to be registered in some states, and California is one of those, as a security offering. Now that's easy. The fee's under $100. You can do it online. It's a simple form. And so that part of it is easy. So that's the plan. The plan usually says we will allow up to 15% of the total number of shares which we've issued, not authorized, You might authorize 1 million and issue 100,000 shares to the founders. So in that case, we'd have 15,000 shares in this plan. The plan allows for options to be granted then to employees. So think of an option plan as the vehicle and the options as the piece of paper that the people get. Well, it'll be digital, but the thing that the people get. You ought to notice that options are best with C Corps, but you can grant options from LLCs or S Corps. Not really a big problem. I do recommend C Corps. Um, I'll stop for a second. It's not in my presentation. A C Corp is the standard corporation. It pays its own taxes for profits, but you know that most of these small businesses we form don't have profits at the beginning. And in fact, those losses can be used as offsets against future profits. And when that happens, it doesn't flow through to your own income statement, so you don't have to pay income tax on your profits yet, which is a good one. And it begins Rule 1202, which those of us who invest know well. If you hold that stock, you investors, including you founders, hold the stock for 5 years, the federal income tax is free up to 10 million bucks. Not bad. So those are the things that I think you need to know about C Corps. But LLCs and S Corps, the money you make or lose pass directly on in proportion to the people who are the owners and founders. That's okay too, but it gets a little sloppy when you have outside investors. All right, so here comes a big one. How to give away too much too soon. Most early stage companies make the mistake of making option grants to new hires at all levels that are just too aggressive. They distort the capital structure of the company to a degree that damages future professional investment. I don't need to say that again. I just need to emphasize it. If you say to somebody, the first employee, I'm going to give you 10%, and that's 2/3 of the entire option pool, that distorts everything. So here are some rules that I think are important, rules of thumb. An option plan should carve out that 15% we just talked about of the fully diluted shares. That doesn't mean the amount that has been authorized, it's the 100,000 number in our case. So let's use the example. If there are 85,000 shares issued to the founders, then a plan calls for 15,000 shares and a pool's reserved for future hires, right? And that makes the total number of shares, including options which could be granted, 100,000. Here it is. The board has to approve the plan. The shareholders must approve the plan as well. That's because anything that dilutes the shareholders' holdings has to be approved by the shareholders. Anything, whether it's phantom stock, whether it's the plan, whether it's anything. Now, issuing stock or options from those plans, once they are granted or authorized, that's okay. That's done by the board. So it's important to note that each grant to every new employee has to be approved by the board before it's legal. And the reason for that is because the board determines or has somebody else determine the valuation for those options. Some of you are already familiar with Carta as a good example, and they are the best example because they're cheap. That Carta will perform what we call a 409A. That's the valuation of the value of the company at any one given time. Now, I don't recommend that for a raw startup that's just begun. Pick a price. If somebody has sold shares to the founders, like the founders buy their own shares, that establishes the price at the very beginning. Really cheap, like you can incorporate for $1,000. But at some point, somebody's going to invest at a valuation of 1 million. At that point in time, if you only have one class of stock, that million sets the valuation of the options as well, which means the options are more expensive. Now, you normally want to grant options cheap to make people want to come to work for you because they're working primarily for the options as well as the small amount of cash that you may pay them as well. So remember that you need to value those options. After a year, when you've gotten going and you have some cash that you've raised, it costs about $1,600 to have Carta do your valuation in that 409A, and that's what you use as your price for the options that you grant. Are you still with me? And if you're not, I'm going to let you ask questions in a few minutes. So those are the rules of thumb. And let's see. Maybe we can stop right here. I'm going to leave these on the screen. JJ, if you can open it up for some questions. I have an equal number of things to talk about, but we got through that part of it fast enough. I'm willing to listen to questions if there's anybody out there asking them.
Sure, certainly. Please ask questions, post them in the Q&A section. I'm sure you have questions. I have questions already. Yeah, please post them in the Q&A section, not in the chat. It makes it easier for us to respond and everybody to see it. And if you don't have questions, that's fine. We will continue.
We will continue, right?
So the section 1202, which most people are not familiar with,
Uh,
it is both for investors and founders, not just
that's
investors. Is that
that's right.
correct?
Hmm.
Which
I made a
means
lot of money based upon saving tax from 409A. I mean, from 1202.
1202, yeah.
It's
Which
close to my
means the
heart.
founders themselves, the capital gain, they can have up to $10 million in capital gain and not pay federal tax on that.
That's right. However, the state of California, in their infinite wisdom, used to have a 50% deduction, and you can guess the next sentence.
Yeah, exactly. Nope,
Hmm.
they don't do it anymore, and
No.
you gotta pay the California tax. So,
Hmm.
all right, no questions so far.
Okay, no questions so far, which means nobody's listening, and I'll just keep talking to myself.
All right.
Uh, By the way, I used to make these valuations myself, and I did it when I was a board member, sometimes advisory board member. And then along came the Dodd-Frank legislation about 10 years ago. And once that happened, it scared the out of me. And it was enough to say that even though a member of the board who is knowledgeable can make this valuation, that has so many risks to it that
Oh,
I've
wow.
stopped doing it.
I
So
did not
those
know that.
days are gone. Yeah. Great.
Maybe I don't know if you're going to talk about this, but maybe talk about the compensation of percent of equity that you would give to board members, advisors, consultants, all that. I don't know if you're going into that, but
Funny you mentioned that. JJ, look
oh,
at the next thing on the screen.
oh well, there you go.
Okay, so how do you price these mothers? First of all, if there's only one class of stock, the same as the founders I mentioned a minute ago, the appraisal of the single class yields the same price as the founders paid or as the last person paid. So it's really difficult to price your options cheaply and legally if that's the problem. Often, though, professional investors want preferred stock, and when they do, then there is a real reason to be able to price these options cheaper because of the preferences that preferred stock have over common stock. Yes, preferred converts to common at a liquidity event, but that doesn't matter. There used to, if I go back 20 years, to around the year 2000 when we were all making a lot of money for doing nothing, uh, there was a rule, and the venture capitalists used it until the IRS spanked them, and it was 1/10. If people paid $2 for a preferred share of stock, then the options were worth 20 cents. Well, those people got spanked, and that means that they were charged a lot of money by federal tax. Nowadays, you have to have the 409A, and I just can't say that often enough. There has to be some way that you can do that, except for the very, very startup or when you only have one class of stock. Okay, so the pricing of the options, um, well, here we go. The multiple prices of stock is what I just kind of covered. And I think it's now time to talk about what JJ asked. What percentages to what job titles? So you bring aboard a new CEO, not typical. And by the way, angels don't usually push CEOs, founders out. Venture capitalists do. And it's one reason why you love the angels. So stick around for the rest of this. So when the angels come aboard and you have somebody who comes in as the new CEO and you take the role, as a founder as the chief development officer, the chief marketing officer, or whatever you are best at. That CEO deserves 5 to 8%. That could be a third to 44% of the total option pool. That's a lot. And that size would take a lot of the pool and kind of scare you. And yes, you could have a vote of the shareholders and increase the option pool. But then a vice president or any CXO candidate typically gets about 1 to 1.5%, a lot less. So now we're extending the way the pool can be allocated. And directors and employees below directors are granted less. A director level employee, that's the third level down. So it's the founders, the CXOs, and then the directors. The directors get about 0.5%. All other grants typically are much lower, like an executive assistant. That could be a fifth of a percent. Who cares? The idea is these numbers are small. If there is a corporate director, and there will be, the corporate directors deserve 1% in the form of options because they carry a liability. One of the reasons why you should think about a special insurance called directors and officers costs about 6,000 bucks. And I know raw startups don't like to pay anything, but I won't serve as a director unless I have D&O insurance from the company. And I have been sued 5 times over 35 years. And I can explain them all. I'm sure that's another story that you'd love to hear. Only one of them did I have to shell out any money at all, and that's a long story because I sued my wife as well, even though she doesn't even know what I do for a living. And so I didn't want her even to be involved, and I settled with the guy after paying $250,000 in legal fees. But all the rest of them I won handily with ease. But that gets off the subject and back to the subject right now is be sure that you have directors who have D&O insurance as soon as you possibly can. Some directors will serve without it because they don't know better. Those of us that have been around may not want to do it for that reason. Okay, so how about vesting of shares over time? Most of us who invest are very familiar with this. Most of you who have never done this before have to hear this now. So options are typically earned over time, even though you grant them. Let's say the CEO that you hire gets 5%. That 5% can't be exercised. They don't really have stock yet because what we do is we usually take 4 years to vest them. And the 4 years to vest them is Um, excuse me, that was a phone. The 4 years to vest them is divided into 1/48th. And typically we try these people out because sometimes people come and go within a matter of months. And we call that a cliff period, 1 year, in which we don't let them vest at all. They're vesting, but they're not allowed to exercise or buy stock from those options. At the end of a year, they've earned 1/4 of their 4 years, and they could, if they want, buy the stock. Nobody does. And then you earn 1/48th for the rest of the 4 years. If that's clear, then that would make it a little bit easy. And so if I give that example, um, if a grant of 10,000 shares is made on January 1st, with this 4 year vesting we're talking about, the 1/48th and the cliff, that means it would take 4 years for somebody to be able to buy all their shares, unless the agreement calls for an acceleration if there's a change of control. If somebody buys 51% of the company or more, then most people are given the opportunity to fully vest and buy their shares because the new company may throw people out. That's just a fact of life, especially CXOs. However, some of these options agreements say that that happens only in the event that the new company has not offered equivalent value in its options. And if the new company has, then there's obviously no value lost. But if there is value lost, they fully vest, you can go ahead and buy them. And the ways in which you can buy them, I'm giving you a rule you haven't heard before, is if you like, and if the agreement calls for it, a cashless exercise. So now you have 10,000 shares, and the price is 10 times as high as it was when the valuation was put on your shares when you got them. Well, you use a tenth of the shares to pay for the shares. And now you get not 10,000, but 9,000. And you're given 9,000 shares. If you're an employee, those 9,000 shares are taxed only when they are sold. And they're usually sold at the M&A event, and that's when you usually exercise too. You don't exercise early, except in one instance I'll tell you in a moment. And in that case, you pay the tax when you get the money and everybody's happy. But what would happen if you're leaving the company early before any M&A event and you want the shares because you really believe in the company's value? And so you buy the shares with either a cashless exercise or with cash. 10,000 shares at $1, you'd pay $10,000. When you pay $10,000, you start your long-term capital gain clock. The 1202 rules, no tax. And you'll have capital gains if it's 5 years from that point to the point of actual sale. Or it is short-term capital gain if it's less than 5 years. And short-term capital gain happens to be taxed at the same rate as ordinary income. You following me? So the other form of options, those granted to people who are not employees, namely directors and consultants and anybody else you grant these to, are non-qualified options. That means there is no protection for capital gains. When they're exercised, they're going to be ordinary income, unless those people fully vest, pay for their shares, and wait 5 years. Then they too are given capital gains protections. Am I keeping you there? This is not easy. This is a lot of rules. So vesting the shares over time, we've talked about. How about these advantages for senior staff? They're called trigger provisions. And it is typically for senior managers. I mentioned a minute ago that if the new company offers equivalent value, you can forget that because you're really just trading one thing for another. But usually they're provided only to select individuals, the ones that are expected to be let go when the new company takes over and the new company hasn't provided enough in the way of options to be the same side. So that's an important one to know. It's really part of the negotiation with a new company when you sell a company. And now I know you're not talking about M&A events yet. I could do an entire half-day workshop on M&A, and I have one. But this is now kind of giving you an introduction. So if this all seems a little bit overwhelming, it is. And I'm going to let you ask any questions you'd like and give you a chance to absorb all of this that I've just said. In the meantime, JJ mentioned books, and so I have a chance to say the Burkonomics series is 3 books, but I've written, what, 14? So Amazon, Barnes & Noble, Make Me Rich, buy a copy. They're somewhere like 14 bucks a piece, a lot less if you buy them as digital books. And you can even buy uh, digital books that are partial books. In other words, if you're only interested in starting up, there's a book called Starting Up for $4 on digital. It's $14 if you buy it in hard copy, soft copy, I'm sorry. And so I think I've told you enough. I'm going to get it off the screen, or maybe I'll put this one back so that anybody asking questions about this will ask. And I'm going to turn it back to you, JJ, and let's see if anybody is even there or even listening, or if I
They are
overwhelmed them.
listening. They are listening. So we have 3 questions in the Q&A. You want me to read them, or you want to click on the Q&A and read them yourself?
Read them. I don't know how to read JJ.
Oh, okay, you don't. Okay.
Read them.
So first one from Robert. 409A valuation is one of about 16 different valuations. Why should later stage investors trust or accept a 409A valuation? Hasn't the market in the last 2+ years deflate the overpriced 409A and other company friendly valuations?
Good question. Great question. Robert, you got a gold star. First of all, the last 2 years have been awful. If you had an appraisal in October 2021, that 409A probably would have been pretty high, higher than the real value after that point in time. The value of these corporations crashed after that time, October 2021, and are just beginning to come back again today. It also tracks with the amount of investment, which also reduced after October 2021 and is coming back again today and will come back big time in 2025. Now, to answer your question. So, if the 409A is too high, and you think the value of the stock is lower, you cannot just plain old lower it without having some authority to do so. If somebody buys a piece of stock, I don't mean one share, but it could be, at a lower price, and it's the same class of stock, common, as the 409A appraisal, yeah, then your price can be lower without another appraisal. If somebody buys it higher than the 409A during that time, you have to raise the price of your options. Whoa. So the 409A is very important. We have had these variations that, Robert, you've talked about over time, but forget the market. This has nothing to do with the market. If you've followed my weekly blogs, and none of you have yet, about 3 weeks ago, I talked about the 10 ways to value a corporation. And 2 weeks ago, I talked about the Berkus method, valuing a pre-revenue corporation. So, if you sign up, you can get onto Berkus.com. You can read those and learn very quickly the valuation methods that lead us to that decision. Is your stock worth more or less? And if so, how did you come to that conclusion? And is it defensible? So, Robert, don't compare it to the public market. We give a 30% discount from the public market as a starting point, and sometimes it's much worse, especially for startups.
All right, and on Berkus.com, it's free to read.
It's free to read. Yeah,
How
this
about
is
that? It's wealth of information for sure. Okay, we have another from Yaya. It says, "Hi, Dave. At the early stage of a startup, what's your take on using vesting schedule versus milestone-based equity allocations for early team members?"
Hi, yeah, and that's a great question. There are many ways you can make an option vest. It is not just time vesting, although that is by far the most typical one. I don't mind milestone vesting at all. In fact, I like it a lot. But you really have to be the kind of a manager that watches the milestones. You need a dashboard, you need a good accounting system, you need to do something that doesn't, at the end of the period, just kind of give in. I've seen it far too many times where a manager doesn't really pay much attention. The time comes, the end of, let's say, a year, and you look at this milestone, you didn't really account for it well, and so you say, okay, you earned it. And so the milestone has to be something that you can watch with the proper metrics. You can watch with maybe quarterly reviews or something where people are really incented to make those milestones happen. Otherwise, you'll find senior managers are soft and they just give in.
That's a good one. Um, yeah, without metrics, there is no way to be able to evaluate what someone's doing and how they perform.
Right.
Um, definitely true. Okay. Another question: Would you deal with I'm sorry, how would you deal with previous investor founders, uh, dead equity, who aren't involved with the company anymore without having any cash or buyback shares? You should have done what Dave said in the very beginning, right? But if you haven't done that, what do you do now, Dave?
Yeah. Okay. So now you have one of the two founders, and this person drifted away from the business, and the person has 40%, and that's such a big number that the other founder feels cheated. And this is how it happens. That's why the buy-sell agreement has to happen. And very few people do it. And yet the buy-sell agreement is so important for this very reason that your question is not only valid, it's important. So no buy-sell agreement. Or if you have one and there's no money from the other founder and there is no money in the corporate treasury and there's nobody out there willing to buy it, nobody who's an accredited investor, then the only reasonable answer is the founder that remains issues a promissory note to the person who's gone and says, I promise to pay you within 10 years the amount of money that's on the face of this, and I'll give you 6% interest credit as well. So, you could get 60% extra if it takes 10 years to do it, but I'll do it at the liquidity event, or I'll do it at the point where the company is at break even, or I'll do it, you can say whatever you want. But then the remaining founder now has, we'll say 100%, because you haven't got a third investor, of the shares. It's the way it is typically done when there's no cash.
That's a great one. How about warrants?
Okay,
Could that be
so
used?
warrants are given not to employees, not to board members, but they're usually extra incentive to investors.
Hmm.
So let's say you have an unknown but fairly understood pricing. Your valuation is $4 million, and the investors feel really uncomfortable with 4 million bucks. They would rather it be 2 million, but you're going to insist on 4 million. So you can give um, those kinds of warrants. A warrant can be priced at a penny, which is like giving stock away, or a warrant is usually priced at the same price as the stock the person bought. It gives them a chance to buy double the amount at some point in time. When that warrant is exercised, then the person pays ordinary income tax on that exercise of the warrant for the difference between its value when exercised and the value of the warrant's face. So, is a warrant a stock option? No. Is a warrant on the cap table? No. So a warrant can be floating out there, and other shareholder candidates, people who are buying shares, may not know that there is this hangover that nobody knows about that will dilute them at some point in time. So be very careful about, well, if you're an investor, be very careful about warrants. If you're the founder, you really have to reveal them. Your lawyer will make you do that as part of the document for whoever is going to invest. And let me answer that one before you ask it. There are several kinds of investments. There are safe notes. Let me throw up all over this because I hate safe notes so badly that I can argue against them for a year's time, even if their clauses make them look like they are promissory notes. Forget safe. I know Y Combinator created them because they had so many graduates, it was just easy to have a single piece of paper at the time that said, I promise to sell the shares at the next valuation. Ouch. Use promissory notes. It's either one piece of paper or two pieces of paper. One is the note agreement and the other is the note. Or one is just the note. I don't care. But use a promissory note. You promise to pay the money in 7 or 10 years with interest of 6%. And it can be exercised anytime. It can be exercised, it must be exercised if there is a change of control. It must be exercised if you raise X amount of money. Sometimes, usually, it's only $1 million. Do a promissory note or pay your attorney and go all the way to get preferred stock. Why would you even do that? Because when you have two classes of stock, remember your 409A, remember the options? You want cheap auctions to bring new employees who come because they think there's a real chance to earn a lot of money here. And if the price is the same as everybody else's price, that's not going to give them any advantage at all, at least for the short run. So if you have two classes of stock, the 409A will definitely appraise the options at a much cheaper rate making them bargains, and allow you to bring new people aboard.
I think you and I can talk about the safe and the others for probably a whole day.
We
Uh,
could. Hmm.
but I am definitely against safes, and especially I just want to make this comment because what I'm seeing lately is someone is raising $5 million on a safe. Well, you know, if you're doing the documents with an attorney for a preferred stock equity round, it's going to cost you maybe 30, 40,000, let's say. If you're raising 5 million, you can afford 40,000. Um, you don't need a safe. And people are just using safe for everything. If you're raising a couple 100,000, maybe let's say half a million on a safe, I don't know. Maybe I'll accept it. But when you're talking in the millions, you can already afford to pay for an equity round.
I got two comments about that. Number one, uh, safe is neither debt nor equity. You
Neither.
can't put it on your balance sheet, and the investor can't say that this comes before equity, it comes before debt, it doesn't come before anything. Where
Yeah.
if it's a convertible note, uh, you really come before all equity, including the founders, if there's this terrible thing like a liquidation event. So you want to have the note, not a safe. The other thing is when you have this preferred stock that you just heard JJ talk about, it's not 40,000 anymore. Most every attorney out there who are dealing with the early stage companies will charge half of that or less, 15 to 20,000 at the
Right.
most,
Yeah.
because these documents almost they're not quite downloadable. I'm being a little facetious. You can download a lot of things, but that's a little more complex. And they want your business, and they want your business more than just this one thing. And they've done this so many times. I've seen attorneys charge as little as $5,000 for the initial preferred agreement.
Right.
That's way less than usual. It's usually 10, 15, not
Yeah.
40.
No, I agree. I was just saying 40
You
could
picked a
be like
number.
the upper limit. Yeah.
Yeah, but you scared me, JJ. So that's not that.
No, I know. So if you're raising, you know, money, you can afford 20 grand. So, all right, we'll move on. We have four more questions here, and
Oh,
please
let's do it.
post your questions in the Q&A. All right, we have Paul. Paul is saying, if one expects an exit fast for a medical device company before 5 years, then might the LLC be a much simpler and better way to go?
No. In
No.
fact, there's a difference between 4.9 and 5.1 years. You remember 409A? Excuse me, 1202. I am chairman of a 14-year-old company. We converted from an LLC to a C Corp, and we waited until January 1st, 2025 to get ready to sell the company. Why? Because we converted exactly on January 1st, 5 years earlier. So why would I want to do an LLC when I don't have a tax advantage as an investor or even as a founder? So I don't care if it's a medical device and you want to sell it in 4.5 years. You might not finish that sale where the money is received until 5.1 years, 5 years and a day. So let's not give yourself a disadvantage. However, if you think there's a lot of losses, you might decide to take the losses year after year after year and stay in LLC. Why not? You can take them off of your other income, but just know someday you'll pay that. There is no free lunch.
All right, next, Yaya again. As we work more with global teams and co-founders, are there US compliance risks related to offering equity to international team or contractors?
Oh, what a question. This is one where you do need an attorney for a lot of reasons. Number one, the international team members can certainly get equity and they can exercise, but we don't have any idea about withholding tax from a Singapore employee an Indian employee, a Philippine employee. We don't know what the tax rates are. In the US, we are required to withhold 20% of whatever we pay to these people, whether it's a liquidity event or anything, because the IRS is going to take it. And some of these countries have treaties with us and some don't. Those that have treaties, like Canada, you can apply if you're a Canadian citizen to get the money back from Canada. Okay. But the rules are really obscure. There are a lot of countries out there. And so the answer is giving options to foreign employees, not easy. You can do it, but their rules maybe, well, they may trump your rules. And therefore, you may have a problem with your income tax because you granted and paid these people at a liquidity event and didn't withhold the money. Just lots of rules that you don't want to know about.
Okay, Paul again. CFOs should be helpers to gain big investors. What do you think of fractional CFOs being able to do this?
It is the way to do it. Young companies can't afford a CFO. What they do is they take a bookkeeper and they call the person a CFO, and that is a disservice because a CFO helps guide the company, especially if the founder doesn't have deep experience in accounting and deep experience in fundraising and deep experience in strategic planning. A good fractional CFO can do all three of those things, helping to train you as that person does it. I highly recommend fractional CFOs.
All right. One more here with Robert. Is it the fiduciary responsibility of the company to disclose warrants upon request?
Oh, yes. Oh, absolutely. Um, you can't keep secrets that dilute people. And what did I say about shareholders? They need to have all the information. They don't vote on warrants. That's what's unusual about this. They do have to vote on option plans, but they don't have to vote on warrants. In a way, they do, because warrants are almost always given when a preferred share is sold. And the preferred share agreement requires the shareholders to vote. So in that case, the preferred shareholders and everybody know about the warrants. But if you sneak out there with some warrants that you've given to somebody for whatever your reason, and you don't have to really tell anybody about it, and suddenly you find out that 40% of your shares were given out as warrants to people for whatever the reason you did badly, and your shareholders could sue.
Okay. I have another question. Maybe it's always uh, I think it comes up all the time, and people mostly don't understand it. How does when you're raising an equity round with preferred and a liquidity preference, how does that translate when there is liquidity? So if you have a one-time liquidity preference
Oh,
or one and
sure.
a half time, yeah.
Okay. So you're speaking now of liquidity preferences, and you're also reminding me about what happens if people have a multiple of some other things. So, uh, in the year 2000, right after the crash, anytime you got an investment, you were lucky. And these investors took advantage of you like you could not believe. I have one of those. It was active.com, which later went public. But at the time, TCA had invested in a company that was bought by Active, and the investor came in right after the 2000 crash and wanted 7x liquidation preference. We thought we were dead. Luis Villalobos and I cried. I don't mean cried, but you know the rest of that, because we knew it would take 3 times the valuation at that point in time for us to just break even. Well, we did. It was 9 times, and we made a good piece of money when it was finally a public IPO. But the usual is 1x preference. What that means is the shares of the preferred will become common shares at the same number of shares as they were as preferred. If they have 2x liquidation preference, and sometimes these people who invest take advantage, or the times are bad, like right now, and they take advantage of the entrepreneur and they get twice the number of shares, 2x liquidation preference, or 3 times the number of shares. Be careful, because that liquidation has to be in the original documents when they were given their shares, revealed to all the rest of the shareholders. Well, when they get 3 times liquidation preference, it usually means that you're in such desperate straits that you're going to have to take the money no matter what, and these people knew it. So your shareholders know it, and they're going to vote for it too. It's a shame. Uh, VCs take advantage of young companies when they need money badly. So what's my first advice? Don't run out of money. Because when you do and you need more, angels will be fine. It's the VCs that will start these 2 and 3 and sometimes more X.
All right. A question from Chad. If you put a stock option plan in place prior to first outside round, will the new investors want to reorganize that plan?
Yes, of course they will. Let's say you have 100,000 shares and they're going to buy 50,000 shares of preferred. They get a third of the company. Well, they quarter the company. Let's do it again. That makes 150. 50, they get a third of the company. That was right. And that means that the 15% is now 10%. And so 10% is too little. They will force you to go through the action with the approval of the shareholders, along with the rest of the approvals, to increase the pool. Remember, I had a 15,000 share pool on 100,000 shares. They're going to increase the pool with 150,000 shares to maybe as much as 20%, which would be 30,000 shares. Why do you do this? They make you increase the pool before they invest, because that makes every one of us who were shareholders before the point, we are the ones who are diluted. Then they come along, put their money in, they're not diluted. So it's another little trap, but it's a legal trap, and it's one that happens every single time. There is no exception on this. And you're right. You have
Yep,
to increase the pool.
makes sense. Great questions today, that's for sure.
Yeah, this is a difficult issue. So yeah, good.
Well, let's do one more, and it's related to kind of the buy sell that you started with earlier today. What
Yeah,
about reverse vesting?
reverse vesting.
So where you
Oh,
take,
sure. Okay,
yeah,
so a founder's shares are vested, which means somebody else is required. Usually the founders don't do it to themselves. That's against their best interests.
right.
Somebody else, an investor says, I'll invest, but I want the founders to vest their shares because I want them there for 4 years or longer.
That's
And
right.
that's reverse vesting.
Yep.
Very good one. I would love to be the investor that requires the founders to put their shares in escrow and vest them all over again, even though they invested their time and maybe not their money, but their time at the beginning. What about reverse vesting? Founders hate it, but they may be required to do it. Investors love it because it forces the founder to stay.
Yep. It's not that common, but I've been seeing it more often lately
Yes.
than before.
And the reason is because these are bad times. And so the investors are in control.
Yeah, exactly.
During the best of times, the investors want to get in quick and they want to get in with everybody else. And a lot of these things are forgotten.
All right. Two more questions now. Paul, what are your impressions of companies like Gust and Forecaster to aid founders to start up?
I love Gust. I was there when Gust was founded. Uh, David's an old friend. By the way, he's written a very good book about angel investing and about how that's for the angel side, not for the entrepreneur side. My books are for entrepreneurs. David Rose. So Gust is great. Use Gust. You can use Gust for accounting. You can use Gust for evaluations. you can use Gus for information. No problem at all. Although they're a little more expensive than Cardiff, but they're good.
All right. Chad, follow-up question. Would the new investor only get equity from the option pool, or would that come from the original founders? Also, are the new investors on a vesting schedule?
New investors. These are investors
Yeah, no vesting.
like those venture group. No, none of that. Let's say you have 100,000 shares, 80,000, 85,000, as we said, 15,000 in your pool. Investors put in 50,000 shares. It dilutes you, but it doesn't take away your shares. So you, instead of having 85% of the company, you now have less than 33%, I mean, less than 66% of the company. But none of your shares were taken from you and never are. These are additional shares. And that's why you authorize 1,000,000 and only issue 100,000, so that you can have these extra shares to be able to sell. And by the way, if you now add this new class of shares, preferred, you have to go back to Delaware or California and authorize another class of shares. And your attorney will do that for you. That would fix it.
All right. So talking about that, maybe two questions maybe you could address as well. One is, what about when, like, we saw a company at one of the TCA screening, I'm gonna say maybe 3, 4 screenings ago, where the founder is now down to about 15% of the company. So maybe talk about why investors may not be interested in investing in that company anymore.
Okay. So here are the rules of thumb, and they work backwards sometimes. Boy, we're getting a little off the subject, but I love this because
Yeah.
people don't get to talk about this. So you start your company, you own 100% between you and your co-founders. Let's forget the options for a minute to make it easy. And somebody invests, and here is the rule of thumb. The typical first investor or first investor group usually wants 20 to 33% of the company. That's just a rule of thumb. So let's do this. We don't know the valuation of the company. I haven't talked about valuation rules, but somebody wants to put in 50,000 bucks. That's a very small number. And you have 100,000 shares, right? They're putting in 50,000 bucks or $1 a share, and they're going to end up with a third of the shares. That valued the company right away at 150,000. Let's say now suddenly that you want a $4 million valuation, and they're willing to pay the share price, whatever that 1/3 is, to make 4 million shares. You are going to be diluted by 20 to 33% because they will engineer the price per share to get that kind of a piece. The problem comes, as JJ kind of alluded, for the second round. If you never need more money, and the company where I'm chairman is about to hire the investment banker and make the run on January 1st, didn't take any more money in all these years, 14 years. So we're in good shape, but that's not typical. You take another round, and that round wants between 20 and 33%. Uh-oh. Now you are down to, making the math simple, 33%. And if you need more money, yeah, you can be down to 15%, and that is true. So what is your reason for staying? I got to tell you that every one of us that starts companies, and I've started 3, so I guess I'm a part of this, every one of us wants to have control. And control usually means 51%. We lose 51% at the second round almost every time. So what does control mean? It usually means that your investors are friendly, that you have some representation on the board, they listen to you, and when you make a valid argument, even though they may believe otherwise, you almost always win, even though you only have 15, 16, 20%. You stick around because it's your baby. You stick around because the valuation may be much higher. You may not stick around if you've been stuffed, a term that is used, when somebody does with a down round and some angry terms like 3x liquidation preference pushed you around and even taken you out of the CFO role, CEO role, and put you into some other role, angering you in three ways. And in that case, sometimes you don't stick around and all is lost. So yeah, we don't like it when you're down to 15% as angels. Venture capitalists will put you down there sometimes if it's their second time around.
Yep. Okay. All right. I wasn't sure if you had more to say in your presentation or we were because we had a lot of questions. Do you
Let's
have
just
more?
talk about,
Yeah.
once again, let's just talk about the books. There's how
Uh,
to get hold of me. There's Berkus.com. There's how to get to the website. I really want to say it again. There are 50,000 people who have subscribed to these weekly emails, another 20,000 that see these on LinkedIn, and it's republished in things like Small Business Advisor from Office Depot, Office Max. It's republished by SoCal Tech. It's republished by the Small Business Something in Southern California. It's republished to make about 120,000 impressions a week. You can be the 120,000 and first, and you can get it on Tuesday morning at 8:30 a.m. every single week free. And what I just talked about, that's just one of the subjects. And if I can do that in 300 to 600 words and you can read it in 3 minutes, why wouldn't you?
that's very true. I get them every Tuesday.
Thank you, JJ.
All right. Okay. Well, I think if there are no questions, um, we're good to go. Thank
Throw
you,
me
Dave.
away.
Yeah,
I will stay and watch David Friedman because he's good. And I'm glad to see he follows me. And
that's right.
you have 20 minutes of dead air, JJ, or are you going to talk?
No, I have 20 minutes of dead air. So
I can
please join
continue with
us.
another subject. I
Oh, you
can.
want you want to talk about another subject?
I can if you like. I'm free.
All right. So I have a question if you guys want to. Go ahead, Robert. You can pose another question before we jump off. Actually, we'll keep it open for another 7 minutes or so till 9:45 or 45 before the hour. 15 before the hour, I should say.
I have a
Go ahead,
short
Robert.
subject I can do if you'd like. No, I'll stay. What did you say? I'll stay for 7 minutes, or I'll stay and do a 15
Well,
minute
because I told Dave Friedman that we will to be on 15 minutes before, and it's a
Well,
different
then
link. Yeah,
you know that he pushes me around and he can do that anytime he wants. We co-host the TCA Crosswords podcast, which
right. I
I
know. I
recommend.
know. Robert, you have a question you want to pose in the Q&A again, or not? You have your hand raised. Go ahead, please do that if you're interested. Meanwhile, I can ask another question while you're doing that.
Sure.
So, Dave, what about so? Yes, you get diluted. Yes, you get, as a founder or as an investor, you do get diluted, right? So, um, but your original, let's say you have just for example, you have 100,000. Your 100,000 was 90%, and now your 100,000 shares are 10%
Yes.
of the company. But you still have 100,000 shares, but those 100,000 shares were $1 each. Now they're $100. So it's still 100,000 at a much bigger valuation. So I'm asking this question because we run into all the time the founders come in and they're asking for huge valuations so they don't get diluted. But at the end of the day, it's the value as the price of the share that's going to count and not the dilution.
Every
What
time.
do you say about that?
Every time. But we all are hoping that's what's going to happen. That money won't burn, that money flows. And so that is exactly the expectation for all of this. And you've said that correctly. If you're down to 15%, but your valuation is up 10 times, you're going to be happy, even though somebody else is going to make more money than you do. They enabled you to make the money that you do.
That's true. So I guess it's okay to get diluted.
In the
And
right times. If you're
that's right.
stuffed, remember that term? If
Yeah.
you're stuffed, that means you've been pushed down at a lower valuation and you're unhappy. But that happens. It happens if you run out of money.
Yep.
Don't run out of money.
Yep. That's right. Okay, so two more questions that came through. Yaya again, is there a recommendation of structuring equity for technical co-founders versus non-technical roles like marketing or sales?
Co-founders often find each other because they have complementary skills. A technical co-founder is just as valuable as an operating co-founder, is just as valuable as a marketing person, is just as valuable as an accounting person. No, no special rules at all. The co-founders decide among themselves how they're going to split. Sometimes they have to put money in. Uh, you can incorporate for $1,000, but you can also incorporate for $50,000 because you need the money for startup, and somebody can't afford it. Now you've got a decision that the person that puts in 30 of the 50 should get more shares than the person that puts in 20 or 5. And so there are a lot of ways in which the negotiation has to go at the very beginning. But buy sell agreement. I don't care what proportions. Somebody's going to leave. Somebody's going to not do the job they were going to do. Somebody's going to have a poor response.
Performance, yeah.
It's and yeah, and so just buy sell agreement.
Yep. I agree because again, one of the things that most founders are technical. What happens is they're not thinking that I can make that thing, whatever it is, that widget, that device, that whatever it is. But who's going to sell it? Somebody's still going to sell that. You need to find the
Darn.
customers. All right. So most technical co-founders are not good marketers. Most of them are not good salespeople. So you need the complementary skills, and they're as valuable. They could be more valuable than the technical co-founder. All right.
So
One last question, Dave, and this is from Robert again. What is your background outside of being an investor? Yeah, definitely a serial entrepreneur.
I began my first business in my bedroom at the age of 15. It was a vinyl record manufacturing company. Of course, I farmed out all of the processes back then. It put me through college. 3 years after college, I was able to build a building. That's how much money I was making. And I began, as I did this, to buy all of the elements of control until I had, in a building in Hollywood, everything you needed to make a record from the studio all the way through the finished pressing and shrink wrap in the same building. The only place on the West Coast where you could do this. But vinyl went out of preference. And I sold the company when that happened and got into the computer business with the programs that I wrote for the vinyl company and made a whole lot of money. And that was the beginning of the mini computer business way back when. I bought serial number 4 of the MAI Basic 4 computer, the very first one with the video. So it goes back. I was there early. And I wrote the second or third system for hotels, reservations and front office ever written. And that was just, more of an extension of this software. And in 1982, which was 10 years after I started this, Marriott uh, licensed it for $3 million, plus paid for the hardware because it was mini computer hardware, which we sold. And that was for 50 courtyards. That was going to be their first brand. And it is now 42 years later. And I'm happy to say that Oracle has tried 3 times to replace this old software, and 4,200 Marriotts are still using this old software because the owners and the managers love it. Training is almost non-existent. So
That's pretty amazing.
I've got a lot of stories.
All right. Well, thanks again, Dave. That was really fantastic. Great answers, great questions from everybody. Stick around for Dave Friedman. He's coming up in about 15 minutes. Use the different link, not this link. And I'll mention that all these webinars and all the presentations during the course of this week, they're all being recorded and they're all online. So if you come back and log in into the platform, just go to the auditorium section and you'll be able to access everything. And this platform is available again for the rest of this week and all next week for you to access everything again. And everything also we recorded is on the Pismo Ventures um, uh, YouTube channel. So follow us or subscribe to the YouTube channel, and you'll be able to also view all the videos from this conference and previous conferences as well. Thank you,
JJ, do
Dave,
me a
so much.
favor before I go.
Yeah.
Uh, what is the link for me to view David Friedman? I don't think I have that.
Oh, I will. I'll email it to you right now. Actually,
Put it in the chat or email, either way.
yeah, I can put it in the chat. If I could find it quickly. I don't have it quickly. Hold on. I'll look very.
Somebody says I should have a radio show. Uh, I did.
You do.
Starting at the age of 16, I had a 5-minute record report in a nationally syndicated show. And then I had my own show on KPPC, which became KPCC over time.
Oh, there you go. Yep.
Yeah, and I was trained as a radio announcer in my teens.
All right. I'm putting this in the chat for you.
Looking,
Okay, here we go.
there it is. I got it. Okay. I'm ready to go and I'm ready to leave, and I'll cry because I'm no longer part of it. But I will watch David perform.
All right. Have a great one, everyone. Talk soon. Bye.